Hello and welcome to Moneycontrol. Well, the Indian economy has been going strong with growth projected about 6.5%, even at a time when China is struggling to restart its economy and the US runs the risk of falling into a recession. Global investors, of course, have been on tenterhooks over the past 1 month because of geopolitical tensions, the possibility of further rate hikes because of supply disruptions, rising crude prices, and so on. But one relief last night was the FOMC decision to keep rates as is. How does the macro setup look? What does it mean for India? Where does India stand in the global context, and especially in the context of emerging markets and Asia? I have a stalwart economist with me to discuss all this. Chetan Ahya, Chief Economist, Asia for Morgan Stanley. So Chetan, since we are talking right after the Fed move, obviously my first question has to be around that. What is Morgan Stanley's house view on whether this indicates a pivot? What do you expect going forward by March or June? When do we start to see rate cuts?
We have been forecasting that the Fed is now not going to take up any more rate hikes. So this has been largely in line with our expectations. But from the market's perspective, it was a bit more dovish outcome than what the markets were building for.
So Chetan, when do you start to see rate cuts? What is your prognosis in terms of when we could start rates actually being cut? Feb, June?
So at this point of time, we think that the first rate cut could come after around 6 months' time. And the key metric that we think that the Fed is watching is unemployment rate and monthly jobs addition. Currently, the inflation outlook has pretty much come in line with what the Fed is wanting to see. And on that, if you look at the core PCE inflation metric on a sequential basis, it's running between 2 to 2.5%, which is a comfortable range for the Fed. But if the unemployment rate is so low, if the Fed tries to sound dovish and ease financial conditions meaningfully, that would revive growth rates higher than underlying potential growth, and therefore take wage growth higher and bring back the inflation risk for the Fed. So now, at this point of time, we think that the jobs data point is the most important one, and it will probably take a few months for the Fed to see those kind of job prints sustainably there for them to think about cutting rates.
Sure. And in terms of, market indicators, bond yields itself, do you have a forecast for end of this year?
So we are expecting bond yields to go down towards the end of the year. And more meaningfully, they should decline in first half of next year. But that is predicated on the view that I mentioned earlier on the Fed path. And to the extent to which the Fed is going to hold on to these high levels of interest rates in the next 6 months, the decline in bond yields will be more gradual, and we don't expect like a big decline in bond yields to be seen in the next few months.
Sure. Chetan, I'll just switch gears to something that you specialize in. I mean, you look at the Asian markets, Asian economies very closely. Explain to us, why is China really struggling to get back growth?
So China, we think, is right now facing significant amount of structural challenges, and those structural challenges are overwhelming the cyclical outlook for China. What are those challenges? So essentially, is the challenge of debt, demographics, and deflation, which we've sort of characterized as the 3D problem that China faces. And that's implying that China is currently recording just about 3.5% on nominal GDP growth basis. Fourth quarter real GDP growth was 4.9, but that was offset quite meaningfully by the fact that GDP deflator was in deflation at minus 1.1%, 1.4%. And then when you're looking at the real GDP growth number, I mentioned it was 4.9. But when you look at the 2-year average number, it's running more closer to 4%. And that's been the main issue with China, that when it was growing before COVID at 6.5%, it's now on an underlying basis growing at 4% on real, and then with the GDP deflator being in deflation, in addition, nominal GDP growth outcomes are even weaker. Now the challenge is that China has been keeping investment to GDP too high. In 2023, investment to GDP is at 40%, and in the last 3 years, we have seen that China's total population has also started to decline. So with the demographics in a position like that, if the policymakers continue to keep investment to GDP ratios high, they are seeing the outcome of that in form of lower capital productivity, or what we call it as economists, incremental capital output ratio is deteriorating. And the other side of that is non-performing loans in the banking system. So when your returns are deteriorating, right, your non-performing loans will be a big challenge, and that is forcing deleveraging in the economy and adding to the downside pressure in the economy.
Sure. But then there are also some policy shifts that China has been attempting, including the recent fiscal stimulus. Do you think in the intermediate term, what is the prognosis for the next 1 to 3 years? Will they be able to, perk it up?
So in the next 12 months, we do expect them to take up both coordinated fiscal and monetary easing to support the recovery. Having said that, to the extent to which they are still looking to reflate through the old sources of growth, which is property and infrastructure, these are the two areas in which they've had the problem of misallocation. So there is a limitation up to which how much they can reflate in these two areas and revive growth rates. So I mentioned earlier to you that we are seeing that underlying growth rates are currently about 4%. And then next year, we expect this to go up to 4.2%. So it's only a modest recovery that we will see in China, because they are facing these structural challenges which are going to constrain their ability to reflate the economy.
And what does this mean for global growth? But even before that, what is your expectation for US and Europe? Because again, in the US, we've been talking about recession for quite some time now. It's just not happened. What is your house view? And what do you think will be the impact of China, continuing to be just about 4% or thereabouts, if we assume in the next 1 to 3 years? What does this mean for the world and India?
So China is an important player in the global economy. And so because of weaker growth in China, we are expecting that global growth will be in the range of 2.8 to 2.9%, which is much lower than the 30-year average of around 3.5%. So global growth will be below trend. And while China is weak, at the same time, we are expecting that US and Europe growth will also be constrained. Yes, the trailing numbers in the US are good, but going forward, we see that as the lagged effect of the policy tightening, which the US is taking up, comes through, GDP growth will slow towards that 1.5 to 2% range from the last quarter print of 2.9% on a year-on-year basis. And so as the DMs are constrained because of this past problem of inflation and them having to slow down their growth rates below trend, and China being somewhat softer, global growth will remain below trend in the next 18 months.
And what does this mean for commodity prices, Chetan? Because for a good part, commodity prices, at least the underlying depends on global growth, particularly China. Now there are geopolitical tensions. There is more, nationalist sentiment, protectionism, and so on one hand, and there is deceleration in overall. When you put these things together, what is the picture you see for commodities?
So, let me break the commodities group in 3 buckets. So that's oil, and food, metals, and then non-oil, non-food commodities. So as far as oil is concerned, our commodity strategist is expecting that oil prices will average around $95 in the fourth quarter. And then next year onwards, it starts to go down. And by the year end of 2024, it will be at about $85. So slightly higher in the near term and then going down gradually over the course of 2024. And for the other commodities, non-oil, non-food commodities, we think there will be a modest upside to select products like copper and aluminum. And for nickel and cobalt, we see some downside. But more or less, the non-oil commodity prices also will be remaining range bound. And food prices are a bit harder to forecast. I mean, they are affected by what happens to the crop outlook and the impact of El Nino. But at this point of time, we're not seeing a big rise in food prices, which is becoming a challenge from inflation perspective for emerging markets like India.
Sure. And how do you see India's third quarter growth, Chetan? And what do you see as potential risk to India's growth going forward?
So India, we're expecting growth in the next quarter to be at 6%, but for the full financial year ending March 2024, we are at 6.4%. And the next financial year, we are at 6.5%. In terms of risk to India story, we are watching for two risks. Number one, what happens to oil prices. And yes, in our base case, we're expecting oil prices to remain range bound. But if you do have a problem on geopolitical front that takes oil prices higher, that would weigh on India, both from current account deficit and inflation perspective, and therefore the investors' sentiment. From level of oil prices that we should watch in terms of threshold at which India will begin to see some pain, we think that level is $110. That is essentially, building in from the sensitivity of India's current account deficit to oil, which is about 30 basis points of GDP for every $10 rise in oil prices. So when you hit $110, current account deficit will be around 2.5%, which will be the threshold at which you will see some currency depreciation pressures, and it will make it difficult for RBI to hold the currency steady as it has been doing in the last few months. And at the same time, you will see some upward pressure on inflation. So, yeah, we think oil prices is one important risk. The number two risk is on the political events. So if you do get an election outcome in May 2024, which is bringing back us back to the coalition type of governments instead of a full majority stable government that we've been having for the last 10 years, then that would be the risk that would be a bigger concern, I would think, from India's story perspective, because it's really this structural growth outlook that has changed, and connected to that, the big shift in the private investment sentiment. And if you have the election outcome, which is not comfortable, that will weigh on the private investment sentiment and therefore the medium-term outlook for India.
Sure. So, Chetan, one question I wanted to ask is, CPI inflation has been above the 4% target rate by RBI for 4 full years now. Now, with multiple unpredictable global developments, especially the war, the pandemic, and so on, have we now entered a phase where the central bank's threshold for tolerance will determine the policy course going forward rather than the targeted rate?
Yeah, so I think from inflation management perspective and inflation target management perspective, RBI has been quite clear in terms of telling us that, look, they want to get down to 4%, but there is a glide path towards it, in the sense that you don't want to try and get to 4% at a pace at which it would sort of cause a significant sacrifice on growth and therefore employment. I think it's also the fact that world over, various other countries, their central banks have had to compromise on getting back to the 2% inflation target, for example, the Fed and the ECB, in a bit more patient manner, because it's going to be quite challenging to get back to that 2% in the shortest possible time. And I think RBI is following a somewhat similar approach. When you have seen supply shocks because of COVID, and then now because of geopolitical developments. You've seen that supply shocks have caused inflation to go up. And so instead of clamping on that supply side inflation aggressively by sacrificing demand and GDP growth, they've chosen this path. And so we think that, you will probably see that approach being sustained by RBI for at least another next, few months before they kind of start to get worried about not getting back to 4%.
Sure. And in the context of Asian economies, Chetan, where do you see India when you look at both growth and vulnerabilities?
So we think India is one of the best positioned emerging markets right now. In fact, you could say almost globally, even compared to other DMs. It has the high growth rates. It does not have a big macro stability problem in terms of inflation or current account balance. And in terms of the investment opportunity for investors, it is hard to find this kind of nominal GDP growth opportunity around the world, which India is able to afford. I just mentioned to you earlier on the call, China's nominal GDP growth at just 3.5%. And India, we think, is going to be able to deliver a sustainable nominal GDP growth of 10, 11%. That just forms a very benign macro backdrop for the corporate sector to be able to generate good profits. And that's what the investors are interested in India. So India has been getting a lot of inflows during this year, while we have seen capital outflows in some of the markets like China.
Fair enough. One question on the interest rate differential between US and India, which is at a 15-year high. Do you think there is room for more compression here? And what happens? Will RBI be in any ways forced to follow what the US Fed does in terms of rate trajectory?
So yes, the gap between nominal interest rates in the US and India have narrowed quite a lot. And if you look at on a real rate basis, that gap is a bit more wider. But even then, you could say that these gaps or the range of interest rate differential between India and the US has come down to very low levels. And whether RBI should be looking at that and taking up policy rates higher. Now, the answer to that is, when we look around the region, what is happening is that the investors are looking at whether these central banks are running policy rates in line with their own growth inflation fundamentals or not. And when you look at that data point in terms of inflation and current account balance for various countries in the region, it is pretty much in comfortable range. And so is the case with India. And so we don't think that the central banks need to take up policy rate hikes to manage their own macro stability indicators. And investors are therefore sort of appreciating that fact that, look, their inflation and current account balance is fine, i.e. the emerging markets like India. And therefore, they don't need to be pressured to take up rates higher, and which is why currencies are well behaved. Unlike in 2013, when the Fed did turn its monetary policy towards tightening, emerging markets like India had to take up significant tightening. But that's because they were managing their macro stability indicators pretty badly, i.e. that current account deficit was high, inflation was in double digits. But in today's situation, we think that India doesn't need to follow the Fed and hike interest rates. It just needs to watch its own macro stability indicators, which are currently in comfortable position.
Fair enough. And just to ask this a little differently, I mean, what is the thinking or what is your sense of how other Asian central banks look at this issue? I mean, the trend in terms of their differential, real and nominal with the US, I mean, how has it moved and what has been the policy narrative there?
So most of the countries in the region are following almost the same approach as I described for RBI. However, there are two central banks which have taken up rate hikes. So that's Bank Indonesia and the Central Bank of Philippines. Philippines has been having a challenge of higher inflation and current account deficit. So for them, it is a bit more, it is different compared to India. So they needed to take up a policy rate hike to manage their macro stability indicators. And for Bank Indonesia, we don't think they needed to hike, but they have nevertheless taken up that rate hike. But we're not expecting a series of rate hikes to begin in Indonesia. Their real interest rates are extremely high. Their policy rate is now at about 6%, and inflation last month printed at 2.3. So the real rates are extremely high. They just took up a precautionary rate hike, but also because their central bank's mandate is different from other central banks in Asia or probably even the rest of the world. The central bank has a mandate, and the first line in their mandate is that they need to manage currency in a stable range. And to the extent to which you were seeing that dollar rise and currency depreciation pressures in for IDR, their central bank took up this 25 basis point precautionary rate hike. But we think that broadly, the rest of the region is following similar approach to RBI, i.e. that they will want to hike only if they see a problem in their macro stability indicators.
Sure. And for India itself, do you think rates have peaked?
Yes, we don't think RBI is going to hike. I think the only scenario in which we can think RBI having to hike is where the Fed is probably hiking more, and at the same time, oil prices are moving up. So, your macro stability indicators in India will also be deteriorating. So in that environment, we could see potentially RBI taking up a rate hike. But other than that, we think that RBI is done, and we expect RBI to take up policy rate cuts, as soon as you get a clear signal from the Fed that they are done and dollar begins to weaken. We think that they will need to wait till that long, because taking up a rate cut at a time when the Fed is still not clear whether it is going to hike more or not will mean that there will be a problem in currency management for RBI, and therefore the imported inflationary pressures.
Sure. One last question, Chetan, with this, inclusion of India into the JP Morgan index, and there is expectation about, India getting included in other indices also. There is about, $20-25 billion of inflows that is expected from passive, and people are predicting that it could be as much as $35 billion or so. If you include active flows also follow. What changes after June when this starts to come into effect? This money will start flowing into India. What changes exactly? How do you see the bonds move thereon? How do you see the RBI, managing this flow? What does it mean for the currency market?
So first of all, I think that is an estimate that even we have. The actual amount of inflow will depend upon what is the sentiment for emerging markets and the dollar at that point of time. But let's assume for the moment that that is the kind of inflow that we will receive. We think those inflows are, relatively moderate size. It will not really mean too much pressure on the INR to appreciate. India still runs current account deficit. So I think in that context, these inflows will be helpful and will ensure that RBI has the control on FX, even if you have some kind of rise in oil prices and geopolitical tensions. So I think it helps overall to manage the macro stability for India, especially the FX. But we're not seeing like a big change because of that in terms of the overall macro story for India.
Fair enough. That's all from me, Chetan. Thank you so much for taking out time for us today.
My pleasure to be with you.